welcome back to the Watch List. I'm Nicole Pentelides, live on the floor of the New York Stock Exchange. Thanks for being with us. We have a few big movers for you. Got to pay attention to these names. Shares of Carvana are soaring to new three-month highs, even after it missed on the top and bottom line of its earnings report. Carvana announced it's cutting costs as demand for used cars remains under pressure. Stock is up over 50% in the week. Wow. Also hitting three-month highs, Fubo TV, after reporting a better-than-expected earnings per share for the second quarter. The company reported 347,000 subscribers for the quarter and is expected 350,000 for the third quarter. Shares are still down over 70% for the year. Semiconductor stock Western Digital is lower after issuing disappointing guidance for the fiscal first quarter. It beat on the top and bottom line for this quarter, but sees sales for the first quarter between 3.6 and 3.8 billion versus an estimate of 4.47 billion. Amazon back in the news as it announced it's acquiring iRobot for $1.7 billion. iRobot is the maker of the Roomba robot vacuum and also has smart home devices and mapping navigation products. Amazon shares slightly lower after announcing this acquisition. Last but not least, let's check in on Bitcoin as we do every single day. 22,860, up 1.8%. Let's get right to Eddy Gifford, Wealth Advisor. Thank you so much for being with us over at Tactive. Good to see you. So what did you think of the week that was, this jobs report that just came in?
Well, I think that jobs have been really doing well, and the Fed has really been focusing on jobs. And so it didn't surprise me this morning when the jobs number came out and was just way above expectations again. And then, of course, we had the initial pullback, a bigger pullback in the NASDAQ. Dow's kind of holding on pretty good. But the thing that we're running into is we had a really bad first 6 months, right? And so after a really bad first 6 months, we've always been positive over the next 6 months. So we've talked about this in the past, but we started kind of positioning more for a rally, but we need to keep in mind that there's rallies and there's recoveries. And I don't think we have enough information yet to say that, hey, we're in a full-on recovery, but I don't think that we're in a recession either at this point. The jobs numbers are really good. And I actually agree with the previous guest. I think it's unlikely that the Fed starts to ease heading into next year, because I think the biggest thing that no one's talking about, maybe some people are talking about, is, well, what if we don't go into a recession? What if there's technically still growth, but we have an extended period of stagflation, where we basically have slow growth and above average inflation for a longer term period of time? That can be recessionary over time. Doesn't mean that it happens in the next 6 months. It might happen in the next 12 months, but it doesn't look like, even if inflation has peaked from what we're seeing, it doesn't seem like the inflation is just going to fall off a cliff on the back end like we were hoping. It seems like it may be kind of like that steady decline, because again, we can only really control interest rates. And the problem with controlling interest rates and increasing those is CPI primarily is based on housing. And so anybody who's buying a house or who's new to the rental market, their costs are skyrocketing. So there's still a lot of stuff. I call this coin flip market, where literally 12 months from now we could be up 50 or down 50%, and it's crazy. So just trying to navigate through all that for our clients.
Yeah, nobody really knows which way we're going here. I mean, there's so many wild cards and uncertainties. That being said, I noticed you have a couple of names in pharma, biotech. You had the IBB, and you also had your outlier in that group, and that's Decipher Pharma. Tell me a little bit about those two trades.
Yeah, they kind of like piggyback off of each other, right? Because they're in the same sector. But we've noticed biotech, we've been talking about biotech for the last couple of years as, this is a premier opportunity long-term that could look a lot like what the QQQ looked like over the last 20 years, which was the top performer of pretty much all indexes. So we think that there's a lot of upside potential on biotech in general, and we've been watching the charts, and we did just cross over the 200-day moving average. And so that's that's a good thing from a technical standpoint. So now it's just about how far can it run up, and how do you protect yourself just in case things roll over, because we've seen that a lot this year, where we've had these rallies where we're like, yes, we're going to make it, we're going to make a lot of money again, and then all of a sudden it does a U-turn on us and hits new lows. So we like it right now as a buy, but we would say that if you're going to buy it, I would probably put a stop in around 109. And the same thing goes for Decipher. They just did really good. They just beat estimates. We saw the stock go up over 20% in a day, broke right through the 200-day moving average, positive again today, poised for growth, a lot of earnings growth potential there. And so we think that that's a category that could come back first. But then again, like we said, we need to make sure that we're protecting things. And so if we were to buy it today, we would probably put a stop in around 13.30 to protect ourselves if everything just rolled over and got real bad real fast again.
I see, because you're right. I mean, it really had a big jump on those quarterly numbers, and to just quantify it, week to date, it's up 35% almost. So we really can see that on a chart, that significant jump that we just witnessed right now after quarterly numbers. And then we turn our attention to treasuries. You're looking short here, right? So tell us, why is that?
Yeah, so I think that, and this was, kind of thinking that jobs are going to continue to stay strong and the Fed is going to continue to stay aggressive and continue to raise. This may not be like a long-term trade. It may be something where really it's a 1 month to 2 month trade, and that's why we're even using the TBT, which is a 2x version. But essentially what happens is, generally speaking, if we're using bonds, interest rates go up, bonds go down, right? So the inverse of that is interest rates go up, and then this holding goes up, right? So we saw today with TLT kind of selling off and interest rates going up today. We see that we've got a 4.5% increase today for TBT. So as long as the Fed is remaining aggressive, we think that this is a good holding. It's more of a diversifier or kind of an outlier risk management tool that we're using to protect against increasing rates. Definitely not like a core holding or anything like that, but we think it's a good spot to buy as rates seem to continue to be rising. And then we've got, like you mentioned, inflation numbers coming in next week. And so if those stay elevated or at least leading into it, we could see rates continue to kind of rise. And then we'd have a stop in at 22 to protect ourselves against all of a sudden things becoming recessionary and the Fed deciding to start easing.
Yeah, understood. And the VIX as a hedge, right? Because right now I see it at 21.26. What are you thinking?
Yeah, well, the VIX, it's one of those things where it's kind of like that offshoot black swan protective mechanism. So if everything is looking good and then everything all of a sudden looks bad and starts to accelerate to the downside, we see the VIX typically climb very, very fast. And so this is one of those things where, with volatility being low right now, relatively speaking to where it's been, and knowing that just generally speaking, and I don't know why, but bad things seem to happen in September and October if they happen. So going out to like an October call option on the VIX that's reasonably priced, that can potentially put you in a situation where you make 20 to 25 to 1 on 3 to 5% of your portfolio that you're using as a hedge. And if we're wrong, that means the market is up 2 months from now. And so, so we lost a little bit of our portfolio, but the rest of the portfolio is up, so we're net positive. So that's exactly what a hedge is meant to do, protect against that worst case scenario. But if we're wrong, we still have the ability to have that portfolio grow. Yeah,
excellent conversation. I appreciate you taking a look at each one of those for us today, Eddy. Thank you. Eddy Gifford, Wealth Advisor at Tactive. Thanks. Coming up next, I want to talk about some of the trends that we're seeing in our